Well, the interest rates went up. That was no surprise, right? We've been in this and at this game with COVID and the long game, and you can't print trillions and trillions and trillions of dollars without seeing some inflation, right? That's going to be how it is. So the Fed raised rates this past month, right, or 3/4 of a whole point. What that means is that the entire rate is a 25% jump in a potential monthly payment. Now, who does this actually affect? So I want to chat about today how this impacts single-family residential real estate and how this impacts commercial real estate as to what we are doing here at the AE Real Estate Group. Number one, let's talk about residential. We already know, and a lot of you already heard my soapbox, as to what's actually happening from the COVID forbearances, right? Where people received their loan statements back in October of 2021 with a demand to pay everything that they hadn't paid over the last 18 months because of COVID. And that's okay, because when they couldn't pay it, they gave another 6 months grace period. So that brought us to March or April of 2022 to pay your mortgage. And if you can't pay it, guess what? It's okay. Because even they'll tack on that residual payment that you owe to the back of your loan. But here's the deal. Most people would get a loan statement like that, and because of the super high demand we were seeing, they could just put it up on the market so long as they had a place to go, which is the big deal, right? And they'd make bank. They'd make a ton of money because of all the demand and pent-up demand here in the residential markets. Well, what are we seeing happening? With rates going up, purchase activity usually starts to come down. In this case, it's going to flatten. And what we've already seen is in the higher end or luxury home divisions or jumbo loans, right, over 750-ish, at least here in the greater Boston and New Hampshire area, things have completely stalled already above the $800,000 price point. There's a lot of price declines. Days on market is starting to go up to 60 and 90 days. And that's the first step as to what the indicators are before there is a correction. So, our advice and what we're going to be doing: stay away from high end, stay away from big developments, stay away from anything that takes over a year and a half to get entitlements or permits for or zoning variances. We're going to stay to our bread and butter, first-time homebuyer homes or the downsizer homes, anything with a price point of less than around here, $550,000. That would be a resale value, ARV under $550,000. So now what does that mean for commercial? Well, here's a question for you. Did your investment sponsor sell you on the biggest part of that deal being the refinance, being the refi rate, right? For most people, everyone loved the BRRRR model, right? Buy, rehab, rent, refinance, and repeat. If you do it over and over again, everyone gets their money back, and it's a fantastic roller coaster, and velocity of capital is amazing. Here's the problem. When rates go up, if your only value add or only big thing in that deal was to take them down, to rehab it, to get the rents up, and you were relying on that refinance to take out all of you and your investors, and you were relying on the cash back for actual returns, even though that's just regular debt, you're going to be in trouble, right? We already saw cap rates starting to compress, and prices going higher and higher and higher when everyone and their brothers, sisters, aunts, and uncles came out to buy multifamily real estate since 2011, right? There's more gurus and coaches now than ever before in multifamily real estate, and there's a reason for that. Because you almost couldn't lose with the interest rate environment, the capital markets, right? And with the demand, the super high demand for rental housing. Now, I personally feel that the rental housing demand is only going to go up, especially when you see the people being pushed out of single-family homes with what's going to happen to the residential markets, right? I don't see income. I don't see renters. I don't see the demand going down at all. But here's what I do see. I see incomes. They're going to take a hit. I don't see renters. I don't see the demand going down at all. But here's what I do see. I see incomes. They're going to take a hit. Right? What happens in a hyperinflation market? What happens every time the government has printed billions and billions and billions and billions and then trillions of dollars and there's debt owed by every single person, right? The companies ultimately are going to have to cut back even tighter than they did during COVID. What that means is incomes are not going to grow as fast as what the values have, as the rents have. So if you have counted, if your investment sponsor said, don't worry, we're going to jack these rents by 20, 25, 30%, which you can still do if you find good value add properties, but don't think that a 3 or 5% inflation of the rents every year is going to make for a good deal. Because we are stress testing our deals at a 0% rent increase after 2023. So we think there's going to be a 3% still, but we're going to stress test it at 0 and also put in some incentives in play. Now, last, what do we think for hospitality? That means Airbnb, short-term rentals. It means RV parks. So a lot of you know our team has been very heavy into the hospitality side over the last year and a half because of how hot the multifamily got. So we found if we could go into certain places that are regulation friendly and implement a certain checklist of value add items that really provides a solid experience for people, be that right a condo with a short-term rental or be it an RV park. We're seeing hospitality still soar out of proportion to multifamily and residential. Not only that, we've just recently taken down one RV park and we have another 2 under contract. And while we are anticipating a bridge loan going into a longer term debt on this, we want to stay away completely from bridge loans. And I want you to know that too with your investment sponsor. So what we're doing now, instead of getting a full bridge loan and hoping that the rates are still within a certain frame in a 12-month or 18-month period when we're ready to refinance, we're going to lenders that are allowing us the flexibility to have a 12 to 18-month stabilization period and then have a temp to permanent loan option so that we already know going in what our rates are going to be, which really solidifies, right, the returns that we see. It solidifies the cash flows from the park. And if we even hit 50% of our business plan and projections, we're going to be okay. That's where I feel that people need to be looking at and being mindful of as we're going into an increased interest rate environment, what it's going to do across the board. Capital markets are going to be the thing that either makes or breaks a real estate portfolio. Right? The availability of cash, the availability of the government coming in or Wall Street coming in and saying, well, we think things are volatile, so we're going to stop the flow of cash. If that happens, values tend to plummet. And there's a lot of fear going around right now with the talk of the recession. So here's the question. How are you prepared to beat inflation? And what safeguards are you putting in place for your investment sponsors or for your own multifamily, RV park, or residential real estate investments? Have a green screen here just in case we could put anything cool in the back for you. But if not, enjoy the green screen, and I'll see you in the next one.